The issue is there's a burden. There's a burden on you. It's a lot more cost heavy to run an S corp because of filing. You have to file a month earlier in March, as opposed to April. However, and you are supposed to have meetings. So with those meetings, you could actually write them off depending using the Augustus rule as an example. That, well, you can take a reasonable amount to host it. You can do it at your house on site, or you can have the several meetings a year at your place, and you can write that off as a business expense.
Hey, it's the Profit Answer Man, Rocky Lalvani. If you're new to the podcast, check out my interview with Mike Michalowicz. It's episode number 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. On the Profit Answer Man, we learn money mastery without all the complicated accounting mumbo-jumbo, using a simple system. Your accountant is busy documenting your transactions and creating a rearview mirror of what happened. My guess is you don't even look at the reports they sent you. If you're like most business owners, you struggle with this, and it's not your fault. We aren't taught money in school, and accountants aren't taught how to be profitable. The Profit First system created by Mike Michalowicz works, and he certified me to help you implement the system in your business. Remember, the new equation is sales minus profit equals expenses. Let's face it, without cash flow, you can't pay your employees, buy needed materials, or pay your mortgage and support your family. I help you to do that and more, so you can focus on the parts of the business you love and receive the rewards for your labor and investment into your business. The stronger you are as a business owner, the more jobs you create, the better we are as a country. Small business owners are the backbone of America, and for that, you deserve to be well rewarded. Just remember, more revenue does not equal more profit. That's why we focus on the bottom line. Today, we're going to chat about profitable entity structures. Yes, there is a cost and a tax savings associated with entity selection, along with some of the other reasons why we need to do it correctly. Before we get to that, let's talk about appropriate business spending in order to keep your taxes low. First, you got to track it and make sure that you've got everything in a line item on your P&L. I can tell you, without visibility, many of you just spend too much money and you don't even realize it. You don't have a good feel for the real cost of your business and your profit and loss. And part of this is to keep your personal, that's a business expense, separate. Because when you keep those dollars separate, when you go to sell your business, you get much, much greater multiples. And that's why we always want to keep those dollars clear. A lot of times you might put those dollars in that spending in your owner's pay bank account. This way you know, hey, that was an optional spend in the business, not a needed business spend. Saving on taxes is one way, but overspending isn't smart here. Picking the right structure or picking an S corp at the wrong time to save on taxes is not a wise move. And we'll cover more of this. And don't forget, our new book, The Profit Blueprint, is out. It's available. It's free on the front page of our website. Profit comes first at the bottom left. Today, we've got my friend Alex Langan on. He is the Chief Investment Officer of Langan Financial Group. It's an award-winning financial planning and wealth management firm with over 100 plus great reviews for organizations and people who work with them. Alex is the second generation in the family to run the business. He's been featured on numerous places. Alex also has a doctor of law from Widener, and he is an adjunct professor at law. So now we get law and money together. Let's meet Alex. Welcome to the Profit Answer Man, Alex Langan. It's great to have you join us today.
Thanks for having me. Excited.
I'm excited for the conversation. Can you share a little bit about yourself and your business?
Absolutely. So, name's Alex Langan. I am an attorney as well as a financial advisor. I have taught as an adjunct professor of law at two local universities and currently help manage my family's wealth management business. We're located in Camp Hill, Pennsylvania. So, probably one of your closer podcasters here. So, yeah.
Definitely one of my closer podcasters. How often do you see an attorney in the financial planning business?
Yeah, few and far between. It's a unique perspective. I like it just as much as about it, like a CPA and advisor, because they give different insights. So it's helpful.
And, for business owners, I think they forget this. You literally should have a team. And on your team should be a CPA, an attorney, a financial planner, and someone like me to help you make money. And all of those people should talk to each other. Because if they're not having conversations, this guy's taking you in this direction, that one's taking you that way, this one's going this way, and I'm screaming and yelling the whole time, going, "What? I don't understand what we're doing," because I see it doesn't fit together.
Absolutely. So you're looking at the bottom line where they're taken home, and you're like, why is everyone screwing up above the line with not getting the money down to me? And so you're correct in that.
Well,
Yeah.
it's beyond that because we look at their entity structures, which is what we're going to talk about, but we look at their entity structures from a tax perspective and from a global planning perspective. And we'll dig into this, but like if you have an S corp and you pay your kids, you don't get the FICA deduction, right? Whereas if you have an LLC and you pay your kids, you do. It's like, hey, you've got young kids, you have these things, your income levels here. These things don't make sense for you. They make sense for your CPA and your attorney because they both bill you for them, but they aren't helping you in building wealth. And then your financial planner's like, why don't you have money for us?
Yeah. Yes. You pay them more money so I can invest it and charge you for it. Yeah. Yeah. Exactly.
It all goes together. So we usually ask how people learn and love Profit First. You don't use Profit First, but you started checking out and listening. And it turns out you kind of do Profit First.
I do it, I think, almost excessively because I have 6 or 7 bank accounts. My money comes in one and then I divvy it up. And so as I'm listening to your podcast, I kept going through it and hearing more and more. I'm like, oh my gosh, I'm glad I'm doing this like correctly. So yeah, it was really funny. And the light bulb went on.
It is. I mean, this is not a patented system. It's basic financial management that you use in personal finance and you use in business finance. It works everywhere. It's honestly, that's the reason I partnered with Profit First is because when I read the book, I'm like, well, this is how I've been running my personal finances since I was 21 years old. This is just what you do. Why wouldn't you do this?
It makes so much sense and it's simple, which is what you need. The more complex it is, the less like you're going to follow it. So yeah, it's a great system.
Not only is it simple, it's automatable. So you don't even have to do anything. All that stuff can happen. Like for me, most of that stuff happens automatically. And you can set it up to do it that way too. We've got ways to automate it. So
I have to learn more about how to automate it. That way I don't even have to click the buttons.
You don't have to click the button. So let's talk about entity structures. Why don't we just start off with why it's so important and what are the different things to consider?
So it is the foundation for how you're going to get paid. And the overarching 2 biggest considerations you need to take are liability, what liability you want to have that's legally speaking, if you get sued or anything, to taxation, which obviously taxation is your number one expense of your lifetime. So the less you pay the government, legally, obviously, but the less you pay the government, the more you can keep or you can reinvest in your business.
So most business owners hate paying taxes. And the problem is they go buy a pickup truck or something useless in the business that they don't need, that doesn't generate more revenue. I think there are appropriate ways to do taxes. Retirement planning is one of my favorite. And I know you guys do advanced retirement planning, but this is probably for a step above most of our listeners. But when you've got millions of dollars in profit at that point, you can look at advanced strategies. But there's a lot of basic stuff for smaller companies too.
Absolutely. You can start with a sole proprietor. I just had a conversation with somebody yesterday. It was like, hey, I was trying to look at my taxes and the federal EIN. I didn't have it because I don't have a business set up. And I'm like, well, you may not know this, but you're a sole proprietor and your federal EIN is your social security number. You're like, that makes so much sense. So starting from there up to, as you pointed, making millions in revenue and getting really complicated. But it's fun along the way. The journey is what's really fun to see people progress and build their business and ultimately for profit.
That it is. So what are the different entity structures and how do you want to kind of go through these?
Sure. If you want to start with the least complicated, sole proprietorship is first one. Then you have an LLC, you switch over to corporations, or limited liability company and LLC. Switch to corporations. There's two main distinct types, an S Corp and a C Corp. And then there's always those funky one-offs like a family limited liability partnership, which very few people do it, nor should they be doing something like that. So you want to start with a sole proprietorship or skip to LLC, whatever you'd like.
Let's touch on sole proprietorship. And for me, the biggest thing with a sole proprietorship is you have to separate your personal life from your business life.
Well, you'd like to. The issue is people are like, no, I just started doing this because somebody asked me to, and then their neighbor asked me, and so on and so forth. And all of a sudden I have a business. So it's the default. Vast majority of people are in sole proprietorships. It's just them building widgets because what they love to do. They don't realize that there is no liability protection. Like if you get sued, they're coming for you. There's no veil there that's going to protect you. So you're liable for it. On the flip side, it's the cheapest thing to set up because you literally don't have to set anything up. It's just file your taxes and so be it. You can still write off a bunch of stuff, but at the end of the day, there's much more sophisticated and probably better ways to set up your business.
Okay, let's move into LLC and S Corp because that's pretty much where I think the majority of the people listening are at.
They should be too. LLC gives you a ton of flexibility, limited liability company. So it's exactly that. You limit your liability to whatever's in that entity structure, the LLC. You can have your taxes in two different ways as an S Corp or a pass-through entity. And you can get into member managed or individualized managed. So depends who you want to govern it. You can choose, or if you don't choose anything, it's you. When you initially establish it, it does cost a little bit of money to set it up. Pay on your attorney if they're really inexpensive, maybe $800. It could cost you a couple $1,000s if they're overcharging you. And if they are overcharging you, they better go to distance with giving you an EIN if it's an S Corp, or also providing articles of organization, which is like your constitution to set up your entity and what you need to.
How many businesses set up their organizational constitution well?
Most don't even have it set up. So it's scary. If that's the case, then you fall back on whatever state you filed in, you fall back on their law. So it just defaults to that. So you need to be the one that thinks. It's tough to think through everything, but you can even set up like your buy-sell agreement inside of that if you have a partner or multiple partners, members. I guess in this situation, they're called members, not partners. But you should definitely consider that. So everyone listening, if you haven't, you better go back, get the dust off your binders, see what's in it, if there's anything in it, because you might actually not even have articles of organization.
So let's talk about this because a lot of my clients come to me and they're like, all right, I'm going to start a partnership with so-and-so. And that's fine. I'm like, cool. The first thing I want to know is what's your dissolution agreement? I want that in writing because most new businesses, it's not that they fail, it's that they break up, right? One partner doesn't do their job, whatever it is, things happen, people go different ways, somebody dies, someone gets divorced. There's a million things that can happen. And if you don't have a good dissolution agreement or a good buy sell or all those agreements up front, I can tell you when you're mad at each other, it's going to be very hard to negotiate at that point.
Exactly. And you don't want to think about the negatives, the terrible what ifs, but what if you get divorced and all of a sudden your 50-50 partner, all of a sudden the ex-spouse comes in and is like, I now own 25% of this business, so let's figure it out. Oh, that's going to go well. Like, yeah. But it happens. I've seen a lot of ex-spouses hold that over the business owner's head, being like, I will own your business if you don't pay me this much more in alimony or whatever it is. So it's a serious bargaining chip. And if you're the innocent bystander business owner, you're going along with the ride.
And so that's why spelling this out up front, who has authority, voting rights, and all of that. And that's the other thing I think. Sometimes, especially smaller business owners, they can't always afford to hire A players. They start giving away equity. And you have to be very careful because now you have become partners with people, and to do that appropriately. I prefer phantom equity where they technically own, but they don't own. Can you explain that?
Yeah, I actually love that too. Or voting shares, non-voting shares. But first, phantom equity it's fake equity. It's as if you own it. You get paid out as if you have equity and get receiving dividends, stock options, getting the money in it. It just mirrors exactly what your stock would be doing or the equity in the company. However, you don't actually own anything. You can even structure it. You can tie in some golden handcuffs into it. So you want to incentivize annually. You just pay it out annually. Hey, our company had X amount of growth. These are our dividends. We'll pretend that you own 5% of it. So you get 5% of the dividends paid out, done. Or you can say, you can tie it into a non-qualified deferred compensation plan that, oh, we're going to pay it into this bucket. We'll save you on taxes, give you the ability to grow. But guess what? If you leave us or go to a competitor or something, you're not going to get any of it. So now you can get pretty sophisticated in exactly how you're going to structure it.
And so I think that's an important part. One other thing, and I didn't realize this till recently, you can have an LLC as an S corp.
Yeah, it can be taxed as an S
It's
corp.
taxed, yeah, because the S corp is an IRS designation. It's not a real designation. Or you can have a corporation and convert to an S corp. But each of those has different rules and different things that I guess you have to deal with.
They do. They're very, very similar. At the end of the day, the vast majority of people do an LLC tax as an S corp, but other ones just start out strictly as an S corp. I always rely on a CPA that's much smarter than me in these areas to say, hey, this is what I should be doing. But it's rare that we see just pure S corps.
So I struggle with that, and I'll tell you why. Some CPAs have a love for a certain type of product for whatever reason, and so they just give everyone that. The other thing is some CPAs, actually, it's not the CPA's fault. Some owners don't tell the CPA what their long-term plan is, and the CPA creates a structure not in alignment with where they're going.
Yes. Well, CPA is always reactive too.
Yes.
It's in their nature. And I love that every tax time we have one or two clients that are like, CPA didn't tell me anything about this. I'm like, well, that's how they are. So yeah, and specifically where they're going is, are you going to sell your company within 5 years? If so, you should probably switch to a very specific entity structure or start cleaning up your books. Hey, remove this entity that's losing you money, make your books a little cleaner, or this line of business. There's so much stuff. I just had this conversation yesterday with somebody that what they were doing in a concrete crushing business that they are trying to clean up because it loses money. So they're like, yeah, we don't want this on the books. Yeah, obviously. But they're using it for write-offs. So that's why they were doing it.
And I get that. There are all kinds of games to be played. The games need to be played with the end game in mind, because if you don't know the end game, you'll mess up. You might win the little games and you lose the big game. So you definitely have to do that.
Yeah, that's Stephen Covey right there. Yeah, smart.
Most of our listeners, I don't think, would want a C Corp. At what point do you really look at a C Corp?
C Corps are, if you have a lot of overhead inventory, the issue is, as you're well aware of, you get taxed twice. So unless you're trying to have the entity itself hold a bunch of money, they have a whole lot of overhead that you just want to keep in it. And you're not distributing nearly as, you're not distributing every year to yourself. So you're not really worried about the double taxation. That's when you want to do something like that. But it's usually very heavy machine oriented companies. And then again, you can always split up your entities and have one as a C Corp that has all the machinery or whatever it is. And you can be just the management company or something. there's a lot you can do with it. This is where it gets fun.
And I think that's the other thing, is the appropriate way to put entities together, because it isn't necessarily just one entity. It's multiple entities. And while we're on that, never put real estate in an S corp. Bad choice.
Fair enough. Yeah, I agree with that. I've never seen that, but yes, absolutely. Absolutely.
I have seen it, and it happens. And I've seen real estate in C corps too, for small business owners. There are some unique reasons for people to own C corps, and they have to do with other things. One of the advantages of a C corp is you can control your income. And if you can control your income, let's say, you're a young family, you got 4 kids, insurance is expensive. Unless you make less than $60,000 a year or whatever the government cliff is. Well, if you own a C corp, you can make less than $60,000 a year, and you get all this free insurance. So that would be a reason, but you really got to think big picture for that one. Let's go to the simple ones. LLC versus S corp, because that seems to be the constant battle.
Okay, so LLC taxes like a pass-through entity. That there is just everything flows to you through your Schedule C. So everything comes to you, just follow on your Social Security number. It's nice because you can have multiple different kind of lines of business that just come to you, multiple 1099s, whatever it is, all comes up. And then you can write off everything that you want. You know how the games are played, or how reasonable business owners strategize. So that's the pass through. You're taxed at the individual level. Everything is essentially income to you, ordinary income.
So in this case, it's one tax return.
Yes. One tax return filed through your Schedule C. In all your multiple 1099s, whoever's throwing them at you, you can just consolidate into one neat little tax filing. The S corp is interesting because you take your reasonable salary. So, and reasonable obviously differs between on your job titles and industry.
But you have to take a salary, which means you have to run payroll. So that's a cost.
Absolutely. Yeah, it's a cost or a headache, depending if you're doing it yourself, which good luck with that. Let me know how that goes for any business owner. That doesn't have ADHD. So you are taking your reasonable salary as a W-2, and then you can take distributions, anything above and beyond that. And the distributions are not subject to the payroll taxes. So it can be more lucrative for people depending.
So let's talk about payroll taxes. So payroll taxes are basically Social Security and Medicare. As a business owner, we pay both sides of it. So I think it's roughly 15 point something change. A little over 15%. However, it's capped. So the Social Security side of it, which is maybe 12 and a half or 13, it's capped, and every year the cap goes up. I'm not even sure what the cap is right now. I think it's around 180,000 roughly.
Okay. Yeah, I was going to say maybe last year was 168 or something, but yeah, I forget where it's at now. And I don't have to worry about 2025.
Right. So here's the thing. If you're making 400,000 and a reasonable salary is 200,000, the S corp saves you no taxes.
Great point. Yes.
Is there an advantage at that point to being an S corp over an LLC beyond that tax savings?
So I'm going to pretend like I'm in law school class. It depends. So if you have other opportunities for the issue is there's a burden. We briefly spoke about this. There's a burden on you. It's a lot more cost heavy to run an S corp because of filing. You have to file a month earlier in March, as opposed to April. However, and you are supposed to have meetings. So with those meetings, you could actually write them off depending using the Augustus rule as an example that, well, you can take a reasonable amount to host it. You can do it at your house on site, or you can have several meetings a year at your place, and you can write that off as a business expense. But in reality, you need to be making quite a bit for the S corp to really make sense.
Oh, above and beyond that. Okay.
Above and beyond 400,000.
Are you not allowed, if you own an LLC, are you not allowed to do the Augusta rule?
You can. you better have good justification for why you're hosting meetings and writing them off, and not just, popping in at your business and doing it there. Why are you going off site? Probably strategic planning with, executives a couple times a year. But I find that you need to really cross your T's, dot your I's with that, because that could be a red flag.
Any other differences between the LLC and the S Corp? I know everyone goes S Corp, S Corp, S Corp. Actually, here's the question. At what point should you consider an S Corp? Because some of these people might only be making 80, 90, 100 grand a year. At what point does all the additional costs, because you've got extra tax returns, you've got the filings, you've got the meetings, I don't know what else you might have to do, payroll. If you're not running payroll, you're running it now.
Yeah, exactly. So it depends on the industry and what the reasonable W-2 income is. So the higher that is, the less it makes sense to be an S Corp. If it's lower, like 40, 50,000, and then you can have a couple $100,000 coming through in distributions, then yeah, maybe it does make sense. So I would say, all things equal, probably I want to be up at $700,000, $750,000 in overall income for me to want to pull that trigger. And that's, as an LLC, you got to think about it. Regardless, you can still write off a lot. So it better be pretty high to be like, okay, my qualified business expenses are just not enough, and now I just have to take these distributions. I'd say at least 750 would be me personally.
And the other thing I see with the S Corp is, once you get above a certain, if you're really making money in an S Corp, you lose your, and none of you are going to know what this is, but there's a QBI deduction. It's qualified, and this is the one time that your calculus class might come in handy, because it's a ridiculous formula. But if you're making a lot of money, S Corps actually hurt you on deductions.
Yeah, they can. And something I found relatively recently was, if you have a solo 401k, so you're self-employed, you have a 401k, you can stick in around 70,000 total a year, depending. If you're putting your employee contributions in, which is 23,500 under 50, if you're contributing into the Roth portion of that, that actually goes against that deductible. So you got to be careful no matter where you're at. You just got to really know the rules, entity structures in general. Otherwise, you could be removing some nice deductibles for you that you could, leverage to get the bottom line profit.
And this comes back to why everyone needs to sit at the table, because there are all, like, when I talk to my clients about this, it's like, yes, this, but no, that, and don't forget about this. And, you can't pay your kids and keep this, not pay the too much. And you really need to sit down and do all the plus minuses, because it's not a simple decision. And I think too often people make the S Corp too simple a decision, because they sell this one discount, which gets the attorney the paperwork to create the S Corp, and the accountant gets 2 tax returns every year.
Yeah, that's a great point. I would hesitate to do an S Corp unless you're really making some good money. I would definitely be hesitant. I personally am an LLC with a pass-through entity structure. It makes the most sense for us. And we evaluate it every year. Maybe next year will be the year, but we've not pulled the trigger.
There are ways to shift money out of FICA through other planning strategies, especially if you're married and your wife helps out in the business. There are all kinds of games that can be played. You just got to know the rules to play them.
Yeah, well, we're a family business, so we have a lot of our family members in it. And my mom, my dad, brothers on payroll. My oldest son's 11. He's showing somewhat of an interest, so maybe he starts coming in here and working some summers. So, and then, the kiddie tax would come in. So there's a lot of ways you can do it. It's just think through, beyond first principles, you got to go to second and third steps to say, hey, does this really make sense?
So the other thing I wanted to talk about is partnerships and entity structure for the partnerships. This is one that I find isn't done well. And here's my favorite. I always believe that if you're going to have a partnership, that the partnership be an LLC and that all of you have your partnership shares in the LLC, and that each owner of the LLC, so each partner, have their own corporation that owns that portion of the LLC. And then within your corporation, whether it's an LLC or an S Corp, you can play all your tax games. And the reason I like that is too many business owners play tax games in the main corporation, and this guy buys the Mercedes, and this one, he wants to buy this, or he wants to go to these conferences, but it's an iffy business like case to the other people. And so instead of working on growing the business, everyone's fighting over tax deductions,
Yep,
right?
I love this.
And so with this kind of a structure, the business always stays clean. Each of your own LLCs individually can play all the tax games you want to play without affecting anybody else, and no one to say yes or no to you. And this way you're hyper-focused on what needs to be done.
I love that idea. We actually had an issue. One of my clients had an issue. They, exact same thing that you just brought up. They had 5 or 6 company cars, and it was all fighting about, no, we all need these high end. They weren't Porsches, but they were pretty darn close. Like, and at some point, you sit there and scratch your head, being like, "How are you justifying all this? And why are you spending so much money on all these nice cars?" Oh, because so and so got one, so I needed one. And it's like, no, you didn't. So waste of time, waste of money, and obviously some pretty big red flags for the IRS to come knocking. So if you don't do anything, you're just a straight up partnership with all the liability. And under agency law, your partner is an agent of yours. Anything they do is legally binding to you. So if he goes out and guarantees a bunch of stuff or does something stupid, driving a company car, gets drunk and crashes, guess what? You could get sued and lose your house if you don't have the liability coverage through the LLC. So absolutely agreed. An LLC, first step. And then I love that idea of setting up separate entities underneath that. So then you don't even have to fight about so-and-so wants this, so-and-so wants that. It's a great idea.
And since your partner's entity owns that car, you're not liable for the fact that he left the Christmas party.
Exactly. Yeah, exactly. Yeah, you're exactly right. So that's a great way to set it up. We have clients that have holding companies set up like that, but I haven't seen anything like that. It's a fascinating idea, and I will definitely be taking that this conversation.
Yeah, my whole goal is how do we keep as much money as possible? How do we reduce all the friction as much as possible? And how do we just be focused? And I'm always trying to find the latest, greatest tax loopholes and how to do that appropriately. And that one was one of the most genius ones that I came across that I did not see a lot of people talking about at all.
No. Yeah, I haven't either. Not to that extent, because usually the first thought is, okay, holding company, and then we'll go, subsidiaries. Or there's new ones out there, LLCs, like a multiple string of LLCs where they can all connect, but they're siloed still. So there is some new interesting ways out there. I almost just want to hold my breath to see what happens with the expiration of Trump tax cuts at this point. But
actually, let's talk about that, breaking the corporate veil. Because the reality is, I hate to say this, I bet you almost everyone listening has broken the corporate veil. And so you're all in trouble. All this business stuff didn't save you. Can you talk about some of the main ways the corporate veil is broken?
Yes. So there's a bunch of red flags. And what that is, piercing the corporate veil is where your alter ego is really you and you're one and the same, meaning that your personal and your business is really one and the same. So you would remove the liability protections and you can get sued personally. A lot of it you see with commingling bank accounts. So that's one of the top flags is, oh, wait a second. You say you're XYZ company, but everything's in your personal bank account. You don't even have a bank account for XYZ company. Guess what? That's not going to protect you. They're going for your personal bank account.
Or there's a lot of personal expenses in your business bank account.
Yes. Although we all know business owners do that, they're fringe benefits. This would be extremely unreasonable. Like, yes, everything you're saying is is professional, it's really personal.
The other thing I see is, and you kind of talked about it, okay, we have multiple LLCs and the LLCs are all paying for each other. We're moving money without paying each other back, and they just put it on the balance sheet.
I just had this conversation with a client where one company was having some serious issues because he was propping up his other company with it. And then they were doing services for the other company at a loss for that company. And so it's like, you're going to find yourself in serious trouble. Like, you're not going to be able to protect yourself from creditors of your one company that's about to go bankrupt because your other company is doing so well by essentially robbing that company.
And if you take excess cash out of one company and put it into another company to hide it from that company, the judge may say, well, this is no longer a going concern because you took excess cash out. And so now that company gets pulled into.
Absolutely. Yeah, you can't just hide money all over the place. I mean, the IRS is probably as good as Doge is at finding where the money's at. So yeah, I would be very careful, cross your T's, dot your I's with everything you're doing and keeping it as legitimate as possible.
Is there anything else they should be aware of from a corporate entity standpoint or behaving appropriately so that everything stays intact?
Obviously, consult your CPA. And if you're like, my CPA won't help me or doesn't know this, maybe you should look for another CPA. Find somebody that's able to.
Does some of this, though, belong with their attorney?
Absolutely. The formation entity structure does belong with the attorney. I know a lot of CPAs that'll help people create an entity structure. It's very easy. You just go on, search online your database, state database, and file for a federal EIN. That said, yeah, you should talk. Attorneys are really good at helping with the liability picture. That's how they first think about it. And then they're getting a tax structure. You get a tax attorney, that's even better. Even better if you can get that.
And that's who I learn a lot from is tax attorneys, because they help me understand what can legally be done. I think the CPAs don't always. CPAs tend to go by the tax code. Tax attorneys tend to go by the tax court and what the tax court says is legal, because the two don't match. And what really matters is what the tax court says. Here's the thing, though, and this was a big aha for me. If you go into tax court and the tax court goes it's 50-50, guess what? You lose.
Oh, yeah.
Automatically goes to them. They win all ties.
Yeah. Good luck fighting that. I mean, I'd even give it 55-45. They might just be like, we're going to take this one, go ahead and appeal, see what happens if you feel like spending the money. So I had a client that wrote off, he was in religious services on top of some other stuff. He wrote off a gold cross that he legitimately thought it was a business expense. State came in and said, we don't think that's right. And so they're like, we want to see your books. He's like, well, what would it cost me? He's like, it's about $27 in taxes. Like, here's a check for $27. Please go away. Like, yeah. Sometimes that's the easiest way.
It is. We occasionally get a tax notice and my wife's like, shut up and pay it. I'm like, yeah, she's the CPA in the family. So
yeah, smart. Yeah. I would listen to her, no matter what. Yeah. But good luck. I personally have been dealing with the tax issue for 4 years now. I paid quarterly taxes. They cashed a check 3 months late for some reason. And then they told me I never paid it. So they're refusing to give me my money back. They said, yes, we see it. We'll pay you back, but they just haven't paid me. So good luck dealing with that's with the state. Good luck dealing with that if that occurs.
Good luck getting the IRS on the phone. And if you do get them on the phone and they tell you something, it doesn't matter.
No,
because whatever they say is irrelevant. Yeah. So you have to have good advice. And I mean, I think that's the bottom line.
100%. Start there. Get good advisors around. Yes. In all courts, you need, as you mentioned earlier on the first started call, an attorney, a good CPA, hopefully a financial advisor, and a profit first man. That's what you need.
Alex, if people would like to learn more about you, find your company, where can they do that?
Google us, langanfinancialgroup.com is the website, or just Google Langan Financial Group, or you can find me, Alexander Langan. I'm on LinkedIn and all over the place. So you should be able to find me, or alex@langanfinancial.com.
We'll put that all in the show notes. Thank you so much for joining us today.
Thanks, Rocky. This was fun.
So, do you have the right entity structure in place? Are you thinking bigger than just taxes? Are you piercing the corporate veil by doing inappropriate things? All of these questions and more need to be addressed by your team. The lawyer, the CPA, the financial planner, and someone like me to quarterback it all to make sure that they are all rowing the same direction and the direction you want to go. And they're not chasing some shiny object of the day. I review all their work because I know you guys don't read your legal contracts. You don't dig into your tax returns, and you don't have the appropriate risk conversations with your financial planner. We do it all for you. And remember, you don't need more resources. You need to be more resourceful. Let's focus on the bottom line and how much cash we keep.
If you'd like for us to be a part of your profitability journey, we have different programs available ranging from do-it-yourself to one-on-one coaching. Our course, The Profit Blueprint, teaches you everything you need to know to transform your profitability. There are 3 different tiers ranging from DIY to done with you so that businesses of all sizes can get the support that's best. Join the waitlist in the show notes to get more information and be a part of the next cohort. If you want a done-for-you service, you can hire us as your chief profitability officers. We only work with a handful of clients, so they all get our full attention. We work with business owners who have or are growing to $500,000 to $10 million in revenue. You can use the scheduling link in the show notes to get on our calendar for a good fit conversation to see if we're the right people to support you and how we can help you.
Remember to check out my other podcast, Richer Soul, where we talk about how to live the ultimate life and be the best business owner you can be. As we close out, let's repeat the mantra. Revenue is vanity, profit is sanity, and cash is king. Have an abundant and profitable week.